This criteria report is a cross-sector criteria, which means we applied across structured finance, asset classes, and covered bonds. It is used in conjunction with the two relevant master criteria at the top of the slide, which describe the basic foundations of our ratings, and other cross-sector criteria, examples of which are also shown. The final line shows examples of sector-specific criteria, which describe the rating drivers and assumptions applicable to a particular sector. We use cross-sector criteria to approach common risks consistently in our ratings across structured finance sectors and covered bonds. A given transaction's interest rate risk profile is an important factor in our rating analysis, because a material open interest rate position would expose the deal to market risk. Fitch's credit ratings do not directly address any risk other than credit risk. The interest rate stresses criteria are therefore designed to ensure deals are not materially exposed to interest rate risk. As shown on the previous slide, the criteria apply to all structured finance transactions and covered bond programs. In addition, the criteria are also used in the rating analysis of U.S. Housing Finance Agency loan programs. The criteria are applicable to both international and national scale ratings. The criteria are primarily addressing the interest rate risk arising from the periodic reset of coupons linked to reference rates of short durations. These are rates that would typically be classified as money market rates. Term structure risks relevant in the cash flow discounting context are not captured. The focus is strictly on the short end of the curve. Consequently, the stressed interest rate paths do not constitute term structures and are not intended to reflect the time value of money beyond the short term. The principal ways in which a deal can be exposed to short rate reset risk is via floating rate note coupons and variable rate assets, as well as interest accruing on reserves and other relevant cash accounts, if such interest accrual is linked to some money market rate. If the application of the interest rate risk criteria affects ratings to an extent comparable to the primary sector risk drivers, such as the credit quality of the asset pool, then the criteria are not applicable. The criteria are applicable to reference rates satisfying the characteristics of money market short rates. This includes legacy IBOR type rates up to the point of their individual discontinuation. The successor rates replacing them are deemed near risk-free. For the major currencies, these are overnight rates, which are typically referenced in contracts as averages over the applicable interest rate accrual period. As a market for forward-looking term rates is developed, these are expected to also fall within the scope of the criteria. If these are fit for the intended purpose, they will display the same risk characteristics, i.e., principally reflect the current overnight rate and expected monetary policy measures over the horizon of the term. The table shows examples of reference rates falling within the criteria scope. In certain jurisdictions, money market instruments are defined to involve specific terms, such as 270 days in the US. The criteria are being applied to terms of up to 12 months, provided the aforementioned characteristics of a money market type reference rate are satisfied. The criteria are framed by 4 key rating drivers. We will discuss these in turn. The 2 key rating drivers in the top row relate to deal characteristics. Hedging. The criteria are applicable where interest rate risk is a residual risk, that is, a sufficiently effective natural or third-party hedge, such as an interest rate swap or cap, is in place. This key rating driver articulates the criteria's basic premise, that interest rate risk itself is not a key rating driver, as the criteria would otherwise not be applicable. Cost of carry. In a high rates environment, the cost associated with non-performing assets increases. The impact of the negative carry associated with a given default and recovery timing profile thus generally increases with the level of interest rates. The other 2 key rating drivers are deal agnostic and relate to the econometric sizing of stresses, macroeconomic expectations. In addition to past rates movements, Fitch's forward-looking macroeconomic expectations inform the criteria's stress parameters, which are equilibrium rates and the high and low plateau levels that are reached at a given rating stress level. Spot and equilibrium rate. The position of the spot rate in relation to the equilibrium rate can have an impact on the stress plateau level. Specifically, if the current spot rate is above the equilibrium rate, then the plateaus reached in the rising rates environment will be pushed up. Conversely, if the current spot rate is below the equilibrium rate, then the lower plateau will be pushed down. We will look into this in more detail. When cash flow modeling a deal, Fitch tests notes interest and principal payment performance under a set of stress assumptions for the model sector-specific rating drivers, such as obligor default rates or recoveries. In addition to sector-specific stresses, interest rates are assumed to migrate to sufficiently remote levels. The criteria define separate sets of stresses for rising and falling rates, regardless of the starting spot rate. If rates are already relatively high, then the rising rate stresses will impose additional increases. Conversely, if rates are low at the time of deal analysis, then falling rates will be pushed closer to zero. In addition to high and low rates environments, Fitch tests notes performance under unchanged rates. The criteria's basic time unit is 1 month. That is, a stressed short rate is generated for each future month for the entire required time horizon. The starting point of the stressed interest rate path is the current spot rate, which in most cases is the value of the reference rate observed as of the deal analysis date. However, in some circumstances, Fitch may use another starting rate in its rating analysis, for instance, a forward-looking rate at times of very volatile short-term money market rates or a steady-state rate for deals with a meaningfully long revolving period. Independent of the modeled currency, the time it takes to reach the plateau, that is the highest or low rates level, is set at 48 months. The plateau levels themselves vary by currency. Negative stresses are modeled separately. Let's take a look at the currency-specific plateau levels. The table shown on this slide can be downloaded via the Interest Rate Stress Models web user interface. To access the web user interface, please follow the link on the criteria's title page. The first column shows the length of the stress ramp-up period, which is, as already mentioned, 48 months for all currencies. Once the plateau for the given stress level is reached, the rate is assumed to remain at this level indefinitely. That is, the value for all months following the 48th is the same high or low plateau level. Please note the distinction between upwards and downwards plateau. This reflects the rising and falling rates regimes. Plateau levels are explicitly only given for the AAA and single B stresses. Plateaus for all other intermediate rating levels are interpolated linearly at notch level. The equilibrium rate is an important calibration parameter because the level of the starting spot rate in relation to the equilibrium rate can move the default levels of the plateaus given in this table. We will illustrate this on the next slide. Example US dollar. We are assuming a starting, i.e. current spot rate of 3.8%, which was the level of SOFR, secured overnight financing rate, at the time of the drafting of this script. At all rating stress levels, the short rate, here SOFR, reaches the upwards and downwards plateau levels after 48 months and stays there for the remainder of the relevant modeling horizon, which in this illustrative example is 60 months. As the graph shows, the AAA plateau is above the 10% quoted in the table. This is because the spot rate of 3.8% already exceeds the equilibrium rate of 3%. In cases like this, the plateau is moved upwards proportionally to the positive difference between the starting spot rate and the equilibrium rate, here 80 basis points. We note that the down plateau applied by the model is unchanged from the 0.2% given in the table. With the current spot rate already above the equilibrium rate, the drop to 0.2% is more remote than it would be if the spot rate was closer to or below the equilibrium rate. In the second part of this criteria explainer, we will dive into the construction of negative rate stresses and discuss basis risks and other special topics. Please navigate to fitchratings.com or click on the link provided on the criteria report's title page.